Your homework assignments, you need to do some exercise problems. I'm gonna go to chapter 7, close chapter 6 here, open chapter 7, and I go all the way down. Chapter 7, it's about long-term assets. Assets that you purchase and you use in your business. And normally we call them property, plant, and equipment. Those are assets that you use them for long time, like 5 years, 3 years, 10 years, and you depreciate them. You capitalize them first, and then you recognize depreciation expense later at the end of each year. We have also intangible assets like trademark, copyright, let's say goodwill, franchise right. Those are all type of assets that has value, future benefit, but long-term benefit, but is intangible technically. Okay. So you're gonna learn how to depreciate the property, plant, and the equipment. You're gonna look at the amortization of intangible assets. And also you're gonna learn what type of journal entry normally you recognize when you dispose any of your asset or sell them or retire them or exchange them for another asset. Okay. When you dispose an asset or sell them, if you sell them for cash, so you receive cash, obviously. But the two things that needs to be closed is, let's say you sell one of your trucks. So you need to close the truck T account because you sold it. Plus you need to close the accumulated depreciation dash truck T account, which is the contra account. In accumulated depreciation, you were accumulating all those depreciations that you already recognized. So the main account, which is truck minus accumulated depreciation dash truck, equals to net value for truck. And if you sell it above net value, it will become a gain that you need to recognize. If you sell it below net value, you need to recognize a loss. So let's go and look at exercises and solve some of them, okay? So in problem exercise 1, chapter 7 says, a company purchases a tract of land and an existing building for $1 million, okay? The company plans to remove the old building and construct a new restaurant on the site. In addition to the purchase price, company pays closing costs, including title insurance, $3,000. The company also pays $14,000 in property taxes, which includes $9,000 of back taxes, which was supposed to be paid by the previous owner, and paid by McCoy on behalf of the seller, and pay $5,000 due for current fiscal year after the purchase date. Shortly after closing, the company pays a contractor $50,000 to tear down the old building and remove it from the site. McCoy is able to sell salvaged material from the old building for $5,000 and pays an additional $11,000 to level the land. Required. Determine the amount McCoy's should record as the cost of land. So remember, when you buy a land with an existing building, if you destroy the building, then all you have is just land, right? So how much did we spend for land? Sorry. So purchase price of land is $1 million. We know that. We paid also for title insurance. escrow fees, back property taxes. Back property taxes is part of purchase price because it was not the new owner responsibility to pay that. It was the old owner, previous owner to pay. Now, if the new buyer is paying for that, that is part of the purchase price. Cost of removing the building, $50,000 to remove the building and have the land ready for intended use. That's part of the cost of land. However, they salvaged $5,000 of copper, aluminum, or something like that from the building. That is a minus because that's cash that they received for those recycling. At the end, also, they paid $11,000 to level and graze the land. Okay, so that's also included. So the total cost of land in the land T account ends up to be $1,068,000. The property tax that they pay for the next coming months, that is property tax expense, and it will be expensed immediately in that year. However, the $9,000 back property tax will be added to the cost of land. Okay. So far, so good. So let's do number 2. These are all most of this homework, okay? So I'm trying to help you on this. Company purchased a new machine and made the following expenditures. So purchase price is $75,000. They paid sales tax, shipping, insurance for the insurance on the machine for the first year. That's different than insurance for shipping. If it is insurance for shipping, then it will be added to the cost of machine. But this is insurance for the first year. That is insurance expense. It will be expensed immediately, but the cost of machine should be capitalized. Installation of machine is $2,000. That's part of cost of machine to be capitalized. So the machine includes tax, sales tax, was purchased on account with payment due in 30 days. The other expenditure listed above paid in cash. So machine and sales tax was on account. Shipping was paid on cash. Insurance for the first year was paid in cash. Installation was paid in cash. Okay, very good. Here we go. So purchase price is $75,000. Sales tax is $6,000. Shipping cost $1,000. Installation $2,000. That gives us a total cost in the T account for machine to be capitalized $84,000. So you capitalize that $84,000. That's a debit equipment. The prepaid insurance needs to be recognized as asset at this point, and by end of the year will be recognized as expense for the months that has been expired. So prepaid insurance will be recognized as current asset, and at the end of the year we will recognize it as insurance expense. We paid $3,700 from as a form of cash. However, the rest, the machine plus shipping was plus sales tax. The machine plus sales tax was capitalized, not shipping. The machine plus sales tax was capitalized. Okay, so that's the journal entry to recognize that. Let's do another good one. 7.3. Red Rock purchased land, building, and equipment for a single basket price of $600,000. However, the estimated fair value of land, building, and equipment are different, obviously. Land is $175,000, building is $455,000, and equipment is $70,000, respectively, for a total estimated fair value of $700,000. So the fair value is 700, but we purchased a good deal basket price of 600,000. Now you are doing the journal entry, what T account you will construct for land, building, and equipment. And here we go. Land is 175,000 out of 700,000 fair market value. That's 25%. Building is 455,000 out of 700 fair market value. That's 65%. Right? Equipment is 70,000 out of 700. That's 10%. Okay. So we have 25%, 65%, and 10%. If you add them up, it's 100%, correct? So far, so good. So 25% of 600, that's $150,000. 65% of 600 basket purchase is $390. 10% of 600 basket purchase is only 60. Add them up, that's 600. That's exact what we are paying. But we know now how much goes into land and building and equipment. Here says in exercise 4, remember before we go exercise 4, land will not depreciate, building and equipment will depreciate based on your estimated depreciation time. So in 7.4 says the company purchased land and building for $2 million to maximize the company's tax deduction for depreciation. Management allocated only 10% of purchase price to land and 90% of purchase price to building. So let me tell you about this. How do you know if it's 10% or whatever? How do you know that? You need to do a fair market value appraisal. That's one way to do it, fair market value appraisal. The next option is when you purchase a land and building together, you get a property tax form by let's say in our county, LA County Assessor Department, Assessor Office. And in that property tax document with 2 vouchers to pay the property tax for the first 6 months and the second 6 months, it shows that the land has been estimated for how much of this purchase and the building how much. So you can use that assessor's estimate as a form of reference if you don't want to get a separate appraisal privately. Okay, so a more reasonable allocation would have been 20% to land and 80% to building. Explain. The tax benefit of allocating less to the land and more to the building. Is the allocation made by company management ethical? Why not? Who, if any, was harmed? So the answer is no, it's not ethical. Land is not depreciated, first of all. So, however, the depreciation on the building is tax deductible, right? So if management allocates less to the land and more to the building, then the company will enjoy a larger overall annual depreciation deduction for the tax purposes. So that's kind of good for company, but is it ethical to do that? Is it correct to do that? No. If the true allocation should have been 20% to land and 80% to building, then the allocation of 10% to land and 90% to building for the express purpose of reducing taxes is not ethical. Who is harmed? The government is clearly harmed as it will collect lower taxes. The general public is also affected as less tax revenue will be collected. If the incorrect allocation is later detected, then the investors and management will be harmed as well. Not only will the company be required to pay additional taxes, it could also be subject to penalties. Okay, so that was a good one. Now let's look at a few more problems, okay? Here we go. Brick Corporation made the following expenditures during the first month of operation. They paid attorney fees to organize the corporation, $9,000. Purchase of patent, $40,000. Legal and other fees for transfer of the patent, $2,500. Advertising, $80,000. Record $131,000 in cash expenditure. That is a good problem. So here we go. Purchase price, legal fees, expense to organize a brand new corporation will be expensed in that year of operation immediately. Patent and the fees. Let's see one more time. Patent and the fees to transfer patent, that will be capitalized. So patent and the fees will be capitalized in the T account for patent. Of course, patent, it's expired after 20 years legal life. So the amortization of patent will be either the legal life or expected life, whichever is shorter, legal life or expected life of patent. Any patent you have is maximum legal life of 20 years. But you might say this type of patent for this type of thing might only be good for 5 years. Let's say most patent in regards to electronics type of innovations, normally they don't last long. So you cannot say, oh, this is 20 years of electronic innovations. Electronic innovations barely survive for 3 to 5 years. After that, it's obsolete. So, so bottom line, whichever is shorter. Advertising expense is always expensed immediately. So that's advertising expense. So you pay cash for this, but some of it will be capitalized like patent. Some of it will be expensed immediately like legal fees and advertising expense. Make sense? Okay, let's do one more. Again, helping you a little bit on your homework problems and understanding of the chapter anyway. So Mainline Produce Corporation acquired all the outstanding common stock of Iceberg for $30 million in cash. The book values and fair values of Iceberg assets and liabilities were as follows. This is a very good question. So let's see. The book value says they have some current asset, they have some property, plant and equipment net of $20,200,000. They have some other assets, they have some current liabilities, they have some long-term liabilities. The fair value of current asset is different, obviously. It is more, it's about 14 million. property, plant, and equipment will also have higher fair value of 26,200,000. Other assets are a little bit, again, higher fair value. Current liabilities are the same, and long-term liabilities, if they want to pay right now, long-term liabilities will be only 12,200,000. So now you have to see what's the difference. Calculate the amount paid for goodwill. So they bought it for 30 million, and we want to see what portion of this 30 million will become goodwill. What is goodwill? Goodwill, it's a dollar amount that you paid to purchase a business above net asset of the business, above the net asset of the business. So net asset of the business, let's calculate it. It's here. We purchased $30 million for the business, but the business has fair value of asset acquired 45 million. So where is that fair value coming from? Here, fair value. You see all those? Fair value of assets, 14, 26, and 4.4 million. And fair value of liabilities assumed. Fair value of liabilities assumed are 12.2 plus 7.8. That is, looks like 20 million. Yes, right there, 20 million. Okay, so 45 fair value of asset minus fair value of liabilities. So fair value of identifiable net asset is only 25. So net asset is 25, but you paid 30. So the extra 5 million you paid because of good location, good business history, good customer list, whatever reason you think it might be a good reason. Because of that, the company paid $5 million extra above net asset and fair value of net asset. That's why we call it goodwill. Goodwill, normally in accounting, you don't depreciate, you don't amortize it, but you can on an annual basis reevaluate your goodwill, and if there is any loss on goodwill by, let's say, after a year or a few years, you revalue your goodwill and you see your business lost a lot of confidence, clients, customers are gone, the business is doing so bad, and therefore you believe portion or percentage of that goodwill has been lost due to circumstances. So in that case, you can write down your goodwill and recognize some loss on that. But other than that, if there is no loss on goodwill revaluation, then goodwill will stay in your balance sheet for as long as necessary. Make sense? Okay, since we are doing this, let's do one more, and that will be problem 7. Satellite system modified its Model Z2 satellite to incorporate a new communication device. The company made the following expenditure: basic research to develop the technology, 3.9 million. Engineering design work, 1.180. Development of prototype device, 590. Testing and modification of the prototype, 390. Legal fees for patent application, 79,000. Legal fees for successful defense of new patent, 39,000. Okay, you spent this much, but during the year-end review of the account related to intangibles, you discovered that the company has capitalized all of the above as the cost of patent, which is not good. Management contended that the device representation represents an improvement of existing communication system of the satellite and therefore should be capitalized. Required. Which of the above costs should satellite system capitalize the patent account in the balance sheet? Which of the above costs should satellite system reports as research and development expense in the income statement? Let me tell you, research and development will be expensed on an annual basis, no matter what. Research and development will always be expensed on an annual basis. So, patent cost that you can capitalize is the legal fees, $79,000, and the legal fees for successful defense, $39,000. If there is no successful defense and you lose patent, then legal fees will be expensed as legal fees expense, and you have to write down your patent as complete loss. But if you spend legal fees to defend your patent and you are successful, then the legal fees will become part of your patent. So all of a sudden, your patent is $118,000 that you need to capitalize. However, the other research and developments that you do on a daily basis, those will be expensed immediately in the year. So research and development, design, prototype, testing, modification, all of them will be research and development expense. Good. So I did a big part of it for you. That is chapter 7. Obviously, there are a little bit more problems to do. I want you to do the rest yourself. Consider obviously reading your book. Normally, I like to read it 2 to 3 times to absorb the information. See how it works for you. Let me know if you have any questions. I am on my office hours too if you like to stop by. Okay. Don't forget to take your exam